Moran from Kansas is recognized.
Mr. Chairman, thank you. Thank you all for being here. Mr. Gruenberg, let me begin with you. I'm going to express in a polite way my dissatisfaction with the demise of the Office of Supervisory Appeals. Despite a multi-year effort by the FDIC to establish, fund, staff, and operationalize the newly minted Office of Supervisory Appeals, which included a robust public comment process, you chose to dismantle this more independent supervisory appeal process just months after it became fully operational, and it was one of your first actions as acting chair. Moreover, you did so through a summary agenda vote without any substantive discussion or prior public notice, providing only a 30-day comment period after the effective date of its demise. How do you justify such an arbitrary waste of FDIC resources with a total disregard for process and transparency?
Thank you, Senator. This is an important issue, as you indicate. A law was passed in 1994 requiring all of our agencies to establish internal appeals processes to consider appeals by our regulated institutions to supervisory determinations. And shortly after the enactment of that law, the FDIC established a board-level committee, a Supervisory Appeals Review Committee, to consider appeals. It was a determination that at the end of the day, the appeals process is very important. Any bank that believes it has, that an examiner has made an inappropriate decision or a wrong decision should have the right to have that decision reviewed by an appropriate process. And I think the view of the FDIC from the time the requirement was established was that a board-level review, which is the highest authority within the agency, is an important matter for board accountability. At the end of the day, the board is responsible for the decisions of our supervisors. If there are issues raised in regard to a supervisory determination, that ultimately should rise to the level of a board review. You accurately indicate that a change was made and an Office of Supervisory Appeals was adopted, utilizing individuals who, from outside of the FDIC, did not necessarily have experience working at the FDIC, but they had supervisory experience of some kind to sit in judgment of these supervisory determinations. I think our view was that board-level accountability was frankly very important in this area, and the Office of Supervisory Appeals had not yet begun functioning. The Supervisory Appeals Review Committee, the board-level committee, had a long-standing history and experience, so we did set aside the Office of Supervisory Appeals and continued the operation of the board-level committee and then sought comment. We received quite a bit of thoughtful comment, and we've now issued a new request for comment incorporating into the proposal some of the suggestions we received in the comments, including placing our ombudsman, who is a neutral party, as a non-voting member of the board-level committee, giving appealing institutions the right to get access to all of the memos and documents relating to the supervisory determination that they are appealing, and also the right to request a stay of the supervisory determination until the appeals process is completed. So it may not be fully satisfactory, but we've tried to take a balanced approach to this, Senator.
And do you place any importance upon, you use the word neutral, I would use the word independent, but whatever that is there a value to having somebody independent or neutral compared to the board?
I think so, and that's why we added the ombudsman to the appeals committee, Senator.
Thank you for your answer. My second question is to the panel. The Federal Housing Finance Agency's tangible capital rules is inconsistent with the federal prudential regulator's capital rules for accessing advances from the Federal Home Loan Bank system. As this interest rate environment continues to escalate with more unrealized losses on typically high-quality treasuries and mortgage-backed securities expected, we will likely see an increasing number of, quote, well-capitalized institutions lose access to key sources of liquidity due to this disparity in the regulatory framework. Although FHFA is well aware of the issue, the default has been for affected Federal Home Loan Bank members to seek waivers in writing from their prudential regulators instead of what I would assume would be a far easier fix, aligning those capital rules. Do you have thoughts about the desire of aligning those capital rules is the first question, and in the absence of that, what's the process for a member institution seeking a waiver from each of your agencies? Mr. Grunberg?
Thank you, Senator. It's an important issue. And this is an FHFA rule that we're dealing with. And FHFA has a requirement that if a bank has negative tangible equity under GAAP accounting, the bank is not allowed access to new Federal Home Bank loans. It can roll over existing loans, but it doesn't have access to new loans until it addresses its capital, its negative tangible equity position.
That's a different standard or rule than any of the folks, the agencies sitting at the table.
The banks have regulatory capital in addition, and that regulatory capital does not count in the unrealized losses that result under, this gets pretty technical, as you know, under GAAP accounting puts it into a negative tangible equity position. So, but it is an underlying risk management issue for the institution if it has negative tangible equity under GAAP. So we are engaging with FHFA and the banking institutions as a threshold. We are looking at the banks addressing their risk management issue resulting from the unrealized losses on their balance sheet, and we'll see if we can work this through.
Thank you.
Are you suggesting you don't expect it to be a problem then for those banks to access federal home loan?
I think this is just, I'm speaking for myself, I think we're looking for the institutions to address the underlying issue, which is the unrealized losses and their negative capital position under GAAP in order to gain access to the home loan.
Let me then ask the question about...
Last question, Senator Moran. You're way over, but go ahead.
I've said here from the beginning, Mr. Chairman, with you and the ranking member.
There's reward for that.
Thank you. Plus our long-standing friendship. Is there a process by which a waiver is obtainable from the prudential regulators, as the Federal Home Loan Bank system suggests? I didn't say that right, as FHFA suggests?
So for us, it's basically using the regular way supervisory process is the way to address that. Just to echo a point that Marty made, we also see this as a risk management, fundamentally a risk management issue, and the alignment question is really a question for FHFA to address.
And if I could, just on a couple of things. First of all, like the OCC, we would look at it through the supervision process overall. I think it's important to remember, though, that when liquidity is provided by a Federal Home Loan Bank, there are assets pledged as collateral for that. And there is a super lien that attaches to that. So we, as a insurer of the deposits that are at credit unions, would be placed potentially, depending on what the asset was pledged, we could have a higher liquidation cost if the institution were to ultimately fail. I think that's even more important why Congress needs to move ahead with the agent-member relationship that we currently do with the corporate credit unions through the Central Liquidity Facility. It is a federal liquidity backstop, and that is another way to deal with this issue.
Thank you. Thank you, Senator Moran.